Hello, dear traders worldwide. This is Gabriel here. Welcome back to my channel, Forex.Real.Trader coaching sessions. Before I say anything else, I want to express my deepest gratitude to all of you on the support to my channel. Thank you so much. Today's video focuses on Module 4 of our coaching course. This is about money management. In this session and the ones to come, we will explore the proper way to understand money management and the essential tools involved. My goal is to ensure that you place trades correctly, considering key factors such as risk per trade, position sizing, risk to reward ratio, stop loss calculation versus take profit criteria, creating a sound trading plan with different proven strategies, among other critical concepts. This knowledge is crucial to preventing your account from being prematurely depleted. But don't worry, later on I will revisit technical analysis and show you how to integrate it with all the concepts we have learned so far. So let's begin by defining what money management is in Forex. Basically, money management refers to the strategies and techniques that us traders use to control risk, preserving our valuable capital, maximizing profits while minimizing losses. Effective money management helps traders maintain long-term profitability and avoid blowing their accounts. Below, we will break down the key moment that we have to take into account regarding money management concepts. And we will provide detailed explanations with examples. Let's begin with risk per trade. Basically, the risk per trade, as you can see here, is the limit risk that you have in every single execution that we have on the trade. Okay. For instance, as you can see here on the screen, the maximum that I must risk in a very responsible way with my account is 3% in every single trade. Let me show you how it works. Let's suppose, for example, that I have my account with, let's suppose that my account is like this one here, say it's $2,000, right? This is my account. This is my capital, right? And I'm going to place one trade. That trade must be equal to 1% of the account if I am very conservative, 2% if I'm a little bit riskier, or maximum 3% in that very single account trade. What it means? Basically means that it's a simple rule of thirds. If my account is $2,000, that is the 100% of my trading capital. And in this trade, I am going to risk only 3%. So what is that 3% in my account? All right. So that is basically a very simple rule of thirds. Just multiplying 2,000 times 3, right? That is 6,000. Okay. Divided into 100. So I am risking in this very trade maximum $60. What it means? That my stop loss, right, in this case, my stop loss is maximum placed to $60 negative. Because I am aiming, and that is something that later on we will work on, is my take profit, right? So what is my take profit aimed at? So remember, risk per trade refers that percentage, in this case of the example, 3%, right, of my trading capital that I am willing to lose on a single trade. It means that if this trade goes against me, right, I am going to lose $60. Let me show you on the charts a potential scenario. Here we go. Let's suppose that I have this potential trade in here to say that I go long, right? Okay. So I'll place suppose my entry point is here. Okay, my entry point is there. And when I calculated 3%, right, out of the trade, means that my stop loss, if here, right, because this is the ideal location for my stop loss. Okay, this stop loss should not be risking, right, from here to here. My stop loss is maximum $60 negative. And my take profit, remember, and that is something I'm going to do, my R, right? So this is 1R. So my take profit must be 1.5 or 2R, my ratio. So if I am risking $60, is because I am aiming to double the money. So in this case, if I am risking here with this 12 pips, is because I am aiming 24 pips, right? So I'm aiming 24 pips is around this price in here. Is because here is my take profit. And it makes sense because if I am risking here $60, right, is because I am looking for earning $120, right, positive. Here I am risking 12 negative, right, but here I am going for 24 positive. That is the outcome, right? That is the forecast of my trade. Okay, never, please never surpass in every trade, never surpass the 3%. 3% per trade, right? Let's suppose, for instance, on this account, doing another example, what my calculation is. Here the balance is $9,726, right? That's it. So that is my 100% capital. This is my capital percent. And I'm going to place a trade in here. So I'm going to risk 3%. So that trade in my stop loss, because that is how I have to understand it, my stop loss has to be that 3%. Is the maximum that I am allowed to lose if the trade goes against me. So let's see how it would eventually be. So it is basically 9,726 times 3 divided into 100. So my stop loss for this trade, my stop loss is $291. So if I lose this $291, I am losing 3% of the account. That is affordable, right? That is the reason, because this risk has to be controlled, right, per trade, and it has to be disciplined, okay, all the time. You have to be consistent, either 3, 2, or 1, but never risking 5% or 7% or 10, because that is going to deplete little by little your account. I tell you for experience. All right. So the thing is to be disciplined about this. What is the potential reward? Okay. So my potential reward is 2. So this is 1R, 2R. So twice 2 is all right. I am risking 291 because I am aiming at, in this point here, I am aiming at $583. $583. Okay? That is the proper way that you have to calculate your trades every time. Okay? You can do this in this way, right? But you can also use, for this calculation with the lots, you can use some websites that are very, very interesting in order to do these kind of calculations. So you won't need to I mean, take into account the number of peeps or things like that. So let's see how it works in this very context. So if I want to use a website, and I'm going to set this website on the description of the video, we can use this one. This is awesome, right? Because it simplifies a lot the way that you're going to save time in the calculation. Let's suppose again that I have my account. My account is 9,726. That is my capital. 9,726. 9,726. And I aim trading one of the majors. Say, for example, yes, euro versus American dollar. Okay, what am I going to risk in here? I'm going to risk $3, 3%, right? So, and my stop, that is the thing, okay? Because yeah, you can calculate your 3%, but let's see if that 3%, according to my pips in here, that I said I am risking 12 pips, right? So I said here 12 pips, okay? And I'm going to calculate the size of my position. So let's calculate. All right, look at this. It's basically what we did with the calculator, okay? A few minutes ago, I am risking on that, with that stop loss, I am risking $291. And the sizing, and that is the next stage in this video, right? Is what is this? The sizing. What's the purpose of this? My dear traders, this is the most important thing, because this is basically the leverage, right? That is the leverage. And now I'm going to tell you how to place a trade. Okay. Clarifying something. I am not using here trading plan strategy. No, no, no. I am just telling you that, okay, once you take your analysis and you do everything sound and safe, all right. So what do? You place the trade, right? So you have analyzed different aspects in here. You see that the thing is going in your way. All right, perfect. So how to place it? Okay. So the proper placing is after you have your clear indicators ready, you proceed. How to do it? Look at me. So let's suppose that I have my entry point here, right? This is my entry point. Let's set it a little bit farther. And here, my 12 pips, because I already calculated that part. So my 12 pips are around 89, this price in here. Okay. And my take profit doubles that. So that is 24. 24 is around this in here. Okay. That is the proper calculation. Now, the question that comes to your minds is, okay, but how do you know you are doing the proper calculation with pips? How do you know the pips? Okay, you always use the crosshair tool. So you place it on your prospected entry point, okay, you sustain the click on your mouse and you drag it down, and you see that 85. So just calculate. This is part of one of the videos, one of the very first videos of the course, how to calculate, how to understand the pips. In this case, 85 is not 85 pips, it's 8.5 pips. So that is the distance. So I continue dragging down. 100 is 10 pips. The last digit, right, we don't count it, right? We don't count it as a unit, okay? So the units are the two previous numbers. So those are 10 pips. Here, for example, 20. Here, 38. 59 pips. Here is 85 pips. Here, 111 pips, right? That is the proper way to do the calculation. That is when I say, all right, so the distance from my entry point from my stop loss is minimum 12 pips. And that is somehow is a rule as well, minimum. So due to the movement of the market, you won't be stopped out. Okay. So how do you calculate again? Okay, use your crosshair, place it on your potential entry point, drag it till you reach the 12 pips. All right. And now that is twice. Remember, if my ratio here is, on my negative, here my stop loss is minus 12 pips, okay, is because I am aiming minimum, or well, in the average, I'm aiming positive 24 pips. Is because here I am risking my risk reward, I am risking 1R in order to get 2R. That is another thing that later on we will check in order how to not to be greedy in the market. We have to be confident but realistic, okay? And the realistic thing is to do 1.5R or 2R or, okay, 3R. But 4R, 5R, so that is 5 times what you're risking, okay? It depends on the strategies, of course, but let's begin with these strategies to be conservative in order to do a sound and constant earning in every trade, okay? So again, risking 12 in order to achieve 24. All right, how to place it? Then you're gonna use your tool on your MetaTrader 5, and the tool is this. Right click and you hit new order, right? That is the new order. Never go market execution, because when you go market execution is because right now you would be buying at this price, but you never know if it is really going to continue its up direction. Or if you hit in here sell, right now you're selling. That is direct market trigger. Don't do that. Always in this type of analysis, we go through this. We go through pending order and hit on buy stop. Buy stop is when you buy above the current price, okay? So if the price now is 29.42, you are buying at 29.46, so upper, right, all the time. So I am aiming to buy at 129.513. So I place it in here. My entry price is 1.29513. My stop loss. Look at this. Those numbers that I'm using come from here. Look at this. My entry, this number is my entry number here. So my stop loss is going to be this number here, and my take profit will be this number here. All right. So that's what I'm doing. I am crossing that information into this window. So what is my stop loss? Is 1.29387. And my take profit will be, I can't see with that color, 29,758. 1.29758. Yeah, let's confirm. Yes, that's it. Look at this. The window, the pop-up window to place the order sets this in blue, right? But now comes something, the volume. Remember this thing here? The volume, this number, this is the number of lots. That number is very important before you trade, right? So you need to know what volume. So what is my number here? So what is the volume that I'm going to trade? Remember my website in here, the one that I used, this one? So this website is showing me based on the parameters that I said, okay, I'm going to trade American dollar versus euro dollar. My account size is 9,726. Okay, my ratio is 3%, is the maximum I'm going to risk. Oh, but look at this. I have my money management is in units, the size is 2 lots and 43. All right, so this number here, this number, okay, this is the number that I am going to place right here on the lots, 2.43, only for this trade. With that amount, with that volume, with that size of the lot, I am risking 3%, right? Let's verify. My entry point, okay. My stop loss, okay. My take profit, perfect. The lot I'm using, perfect. The currency pair, oh my God, look at this. In my chart is pound versus dollar. And on the website is euro versus dollar. So what I do, it happens. So basically I change here and I look for that pair, GBP, USD. All right, and let's calculate again. And according to this, a little bit more. So the lot can be a little bit bigger, 2.43. So I do the adjustment here. I know it's the same. Look at this, 2.43, didn't change at all. Okay, what is the next step? Place, right? And let me delete my guidelines. That's it. Now you can observe these lines here, right? Look at this. You can see the lines of MetaTrader 5. This green line here, this one, this green line is what? Is my entry. This red line here is my stop loss, and this red line here is my take profit. If the price, in this moment, look at this, the trade was placed, but not triggered. It is triggered when you start to see movement here, right? When you start to see the money or the pips or the units moving in there in positive, negative, you know. In this moment, was not triggered. Eventually, if this candle or coming candles reach this price line, it will trigger my trade. I am in the market. In that moment, I start to play, okay? And if it continues going up, boom, and gets here, hits my take profit, and that is my money, that in this case was what? Around $580 something, right? But that is positive. But if the price, okay, triggered my entry price, comes up, and then start the movement and coming down, and then hits my take profit, then that's gonna be minus $291. So it touched my stop loss. But don't worry, that means only 3% of my account. And that is the way how I am consistent. Because if I win, I always win more than I lose. Okay? Another thing that we have to bear in mind is this. Never, please, never move stops. okay? There is a tendency, and that is directly aligned with trading psychology. And is that tendency of moving the take profits when they go against us, when the trade is going against us? No, because let me show you. Let's suppose that the trade was triggered, right? And now it's coming against my position. Okay, the simple thing is to do this. All right, now I'm going to move in. Now you are not risking in that trade, you are not risking 3%. Remember that was the calculation? So you are ruining your trading plan because you are not disciplined. So if you do that, let me tell you what happened. You stop risking 12 pips here to risk 33. So you are risking now around 9% of your account, right? And that is what? That is not $291. That is around 700 negative dollars, right? So don't do it, okay? Moving stops is something that we must avoid at all costs, right? Moving them in the negative way. We can move the stop loss in a positive way when we are getting that the trade is in our favor so we can secure our profits. But that's something that we will do later on. Okay. So, my dear traders, this is the first session related to risk position sizing, right? And how to properly work risk per trade, right? So, my dear traders, just a little reminder, if you find my channel and the information here provided is something useful, interesting, and somehow important in your trading learning process, please subscribe, like, and share so we can build a well-informed community of Forex retail traders. Once again, thank you very much for your awesome, valuable, and I really appreciate the support that you are having to my channel. Thank you very much. See you in the next video.